Did you know CPAs work around the clock on taxes, audits? Yes, it's quite a shock. But business owners, they've got a dream. More tax saving strategy, that's what they need. Welcome to Proactive Tax Strategies. And we're here to take away high tax fears. We got secrets, magic in our heads. Tune in as we travel.
Welcome to another episode of Proactive Tax Strategies. I'm Patrice Sikora, and we're happy you're joining us today. Our host, Ken New, brings more than 25 years of financial industry experience and expertise. Ken began his financial career at John Hancock, but today he is the founder and owner of Pinnacle Financial Wealth Management, a private financial firm dedicated to providing holistic financial management and proactive tax strategies to high net worth individuals, CPAs, fellow advisors, and attorneys. As a team-based consultant, Ken collaborates with both local and national experts within an exclusive virtual family office model to provide a holistic approach to financial planning. Ken's dedication to full financial planning allows him to provide more value and increase client satisfaction. Ken is dedicated to discovering options for income and retirement planning with a definitive strategy to reduce taxes. Ken New is the host of the Proactive Tax Strategies podcast, where he showcases many unique tax mitigation strategies and retirement topics. And today, we have a special guest, Aleksander Dyo, Managing Director of Wealth Excel. Aleksander is a distinguished financial expert known for his innovative work with advanced retirement plans and financed charitable giving strategies. With over a decade of experience, Aleksander has a track record of helping high-earning individuals and business owners save over $60 million in taxes through sophisticated techniques. He has crafted the Pre-Tax Wealth Creation Blueprint, a powerful tool that amplifies charitable giving, maximizes tax savings, and accelerates wealth growth. So, without further ado, I'm going to turn the show over to you, Ken. Take it away.
Thank you, Patrice. I appreciate that. And welcome, everyone, to Proactive Tax Strategies. I'm Ken New. I'm your host. And as Patrice said, we have a very exciting segment today. So many of you listeners, you know our goal is to show diverse strategies that optimize your whole financial landscape. And primarily, they are tax mitigation strategies and financial preservation strategies. Typically the lesser known strategies, but very highly effective. And today we have one of those. So I've over the years seen many high net worth, high income individuals, business owners, entrepreneurs with huge tax obligations, six figures. And it's really gratifying to see that these tax bills can be significantly reduced, sometimes eliminated. And many times the CPAs don't know or don't have the knowledge of these strategies. And so today we're going to dive into this. We're going to get into tax mitigation with Aleksander Dyo, and he's going to be talking to us about using the charitable gift financing strategy. So, Alex, pleasure to have you on the show today.
Thanks, Ken, for having me. I'm excited to be on your podcast as well.
So Patrice told us a little about you in the beginning, and it kind of sets the stage a bit, but in your own words, tell us a little bit about what you do.
Yeah, Ken, this year marks my 21st anniversary. I can't believe time flies by.
Well, congratulations.
Yeah, thank you. And financial services industry been for me all these years that I don't know anything else but financial services, it seems like. And over the past decade or so, my work has predominantly been concentrated on two main areas. And one of them would be advanced pension plans, where we provide comprehensive third-party administration services and asset management. And second, being finance charitable giving, a strategy that we're discussing today. And we handle everything from underwriting to execution of the loan and life insurance collateral for our clients. And we usually work very much closely with CPAs, just like you, insurance agents, financial and investment advisors, and we act as an extension of their services. Our role predominantly is to enhance their clients' tax savings and offering various strategies revolved around these two practices that I just mentioned to help their clients achieve greater tax savings. That's essentially what we do.
Yeah, terrific. Well, I have to tell you, though, I think a lot of people listening are probably thinking, this strategy sounds pretty complicated, maybe a little more sophisticated than I need. And it also sounds like I need to write a big fat check to charity just to save some tax dollars. The charitable gift financing strategy does, of course, amplify the overall giving, maximizing tax savings, and also creates a lasting legacy. But maybe we should dive into it a bit and help explain what all that means.
Sure can. And the concept of charitable gift financing is fairly straightforward. And the easiest way to explain it without going into the weeds of various technicalities is actually by looking at the world of finance in general. If we take in consideration anything from your home, investment property, cars, equipment, furniture, vacation, various services, and so on and so forth, everything can be financed. So the question is, why not charitable gifts? And in fact, a lot of people who donate to various causes already use a very common form of financing called credit card. And I always give this example in my presentation. If someone watches a commercial of a Red Cross and compelled to give however much, let's just say in our example, $10,000, they typically wouldn't send cash of $10,000 or in this day and age, even write a check. They conveniently would pull out from their wallet a credit card, put the information, and the $10,000 will be sent to a Red Cross. Red Cross recognizes this $10,000 in the name of the donor without actually crediting it to the credit card, but rather to a person who attached to that credit card. What do we have here? Is a very classical example that the client borrowed money from a credit card. And client, so long as receives a receipt from a charitable organization, in this case, it's a Red Cross, qualifies for a deduction of $10,000. Later on, client dealing with a credit card, whether repaying it the next month in installment payments, or however arrangement that the client may have with that credit card, or what if the client doesn't pay $10,000 at all to a credit card? That does not necessarily mean that IRS would disqualify that $10,000 for the purposes of a deduction. The client deals with the client on the personal level. This is a business matter that obviously a client would go through some consequences if he or she doesn't pay that off. But the fact of on the tax deductibility, client receives $10,000 worth of deduction. So it's a very straightforward example, which I think a lot of people would resonate with. And using any form of financing, whether through the credit card, line of credit, and borrowing from a specialized third-party lender for the purposes of giving. All of these methods use the same IRC revenue ruling code 7838. This strategy has been around forever, since 1978. In fact, since 401ks were established. The law interprets as follows. When a person borrows, essentially establishing the debt to a third party, and that debt is used to make a charitable contribution, the taxpayer is entitled to a charitable contribution deduction under IRC Code 178 in that particular year that the gift was made. They don't have to wait until that debt is repaid to claim that deduction. And that is exactly what we're dealing here in this strategy.
And that's great that you use the credit card analogy, because I think we get so complacent about credit cards, we don't think of it as financing, but it is. We use that credit and we get a benefit from it. In this case, you're equating it to qualifying this tax deduction. And so we begin to kind of, I think, open our minds to the ability to be able to leverage the financing to get involved in the strategy. But let's now take a dive into the strategy and see how it really works.
Yeah, absolutely, Ken. And thanks very much for, I guess, furthering my credit card explanation. And I hope by now the audience grasped the concept of charitable gift financing at the high level, at least. To delve deeper into the mechanics of the strategy, I'd like to bring a case study, because I think that would be significantly easier to comprehend the complexities of the strategy.
Yeah.
So the background is as follows. So it's a couple living in California. Hello, California. So the highest tax bracket, right, in the United States. And this couple happens to make $1 million in our example of adjusted gross income. And what they're looking for, two things. Number one is to give generously. And number two, reducing their tax liability. Pretty straightforward background. So here's how things can work for this couple. Normally, anyone who would contribute cash, they would qualify for a deduction up to 60% of their AGI. In our case, what if this couple contributes $600,000, which is a 60% of their $1 million AGI, to a charity? They stand to reduce their taxable income, obviously, and the outcome that taxable income would be $400,000. What has been accomplished is significant lowering their tax burden, since they'd only be taxed on the $400,000. However, not everyone obviously is comfortable or willing to write a check for $600,000, no matter how much that would help them with reducing their tax burden. Why? Because the remaining income of $400,000 would still be taxable. Well, this is where the financing proves to be really powerful. They could opt into financing 90% of the same charitable gift, which would equate to $540,000, which is a 90% of a $600,000 of gift that they would give to a charity in form of a cash. And how do they do that? They would essentially go to a specialized third-party lender, and that in itself creates an enormous amount of leverage for them as far as a cash outflow, because they are left with only 10% of that gift as far as a cash outflow is concerned, of $60,000. That is only how much they need to put away in order for them to claim the full deduction of a $600,000, which essentially maximizing their tax savings while minimizing the immediate financial impact, if you think about it. This strategy not only fulfills their philanthropic goals by contributing significantly larger amount, but does so in a financially savvy manner. So what I just described is the power of a financing where a person contributing a larger sum of money to a charitable organization can claim a large amount of deduction without technically putting away the full amount. So that's really, really powerful. Naturally, people would ask, okay, well, that's fantastic, but I'm still on the hook to repay $540,000. How does that work? Well, let's address these concerns to bring our discussion full circle. I would demonstrate how this approach can be suitable and impactful without putting undue financial strain on the donor. So number one, how would the loan be repaid? Firstly, we use collateral via life insurance. The repayment of the loan is uniquely structured through collateral. In our case, it's specifically permanent life insurance death benefit. This means the loan will be settled upon the client's passing, not during their lifetime. In other words, client is not required to make any interest payments and or principal repayment the loan in full will be repaid at the time of client's passing. Number two, this loan comes with a very lucrative terms, non-recourse loan. To further describe what that means, it's essentially a client is not personally liable. If they're not personally liable, that doesn't go against their personal credit. Their capacity as far as borrowability remains the same. It doesn't impact their credit. And the only security that the lender has is the life insurance proceeds. Number three, we use a special grantor trust for the purposes of borrowing. So effectively, the trust will be used as a proxy, in other words, not the client directly or the taxpayer or the donor, however you call these people who engage in this particular transaction. What does it do? This separates the client's personal assets from the transaction and further providing additional legal and financial safeguards. Number four, it's a balloon note structure. And the terms of the loan are such that it is a interest accrues and is added to the loan balance over time, not requiring ongoing out-of-pocket expenses. And finally, number five, the eventual payout in charitable continuation. This is probably my favorite one because upon the client's passing, the life insurance obviously does its job and pays off the loan. Or in other words, it's settled to pay off the loan completely. After the loan is fully repaid, notably up to 50% of that repaid loan amount can then be directed to any charity chosen by the client. This is another way of looking at the deferred benefit or endowed benefit of this transaction, where it creates a perpetual giving model, enabling the client's philanthropic impact to extend beyond their lifetime, and essentially fostering family legacy of giving for future generations. Well, in conclusion, in my example that I brought, number one, this strategy not only meets immediate charitable goals for the clients, which effectively amplifying that gift. Number two, provides significant tax savings. But number three, it also ensures that the client's commitment to philanthropy carries on, I would say, cementing a lasting legacy without compromising financial security. Ken, I hope that kind of described in more details what the strategy does and how it works.
Absolutely does. And what it does do, Alex, is it begins to help us to see that there is some complexity to it. And that complexity is what creates this value, I think, that is available. I'm going to walk back a little bit and unpack this for a moment, just so that the listeners get the big picture idea of what's going on. First of all, there is a check that is being written, but it's not the $600,000 check. It's a $60,000 check. But the power of writing that $60,000 check is that it creates a significant tax savings. And again, remind us what that tax savings is at that point.
In general, we're looking at very much healthy arbitrage. And typically for a couple who makes $1 million and living in the state of California, they easily would pay 45% between federal and state, which translates to roughly $450,000 of taxes, which, by the way, they already one way or another gift that $450,000 to charity that creates public benefits called IRS.
I love, though, the way you've explained that. Yeah, they've gifted it to the government.
Yes, correct. So here, by utilizing this strategy, they have options. The options that are probably much better suited for the client than just by default giving it to a charity, in quote, that may not necessarily be in line with the client's charitable beliefs. or beliefs in general of how the dollars are spent to create various public benefits. Here, to kind of walk back to what I said, for a couple who is making $1 million of AGI, they would easily pay 45%, which is a $450,000 of taxes. If they were to utilize a deduction worth $600,000, now their income turns to $400,000, in which matter that $400,000 not only bears lower tax bracket, but even if we apply the same analogy of a 45%, which is not right, but I'm going to use the actual tax bracket potentially of maybe 30%. So they would pay $120,000 or so on the remaining balance. So 30% times $400,000. Here we have a very hefty arbitrage between $450,000 that they would have paid, and after the implementation of the strategy, $120,000. And the difference, 450 minus 120, equals to roughly $330,000. And this is how much tax savings we are talking about. That's a significant amount. Yes, we have to add back some of the direct contributions that they would be putting in and some costs associated with the transaction. But on a high level, considering that $450,000 would have been given to IRS anyways, here they stand to save $330,000 of cash. This is a lot of money, Ken.
Absolutely. And that's where I wanted to make sure that we were understanding, the listeners could understand that there's a real tax savings here in this strategy. And then it evolves into the charitable goal, the gifting part of it.
Yeah, absolutely. I mean, the tax savings, I think it's a byproduct in our view. So a lot of our clients who entertain the strategy, they are absolutely charitably inclined to begin with. And if there is a way for them to amplify it further or increase that amount of gift to make a greater impact, they would do that, because math is a math. And by making those contributions wisely, utilizing specialized third-party lenders' facilities, they automatically would have this great tax savings impact. Don't get me wrong. It is huge. It is important. But I think it's more of a, wow, it comes with it, rather than the drive is to have a tax savings first and then the giving. So a lot of clients may be compelled to do that and then become further charitably inclined. But most of our clients, they are charitable inclined to begin with. And of course, they look at dollars when it comes to the tax savings.
Sure, yeah. And here you're able to help them to use those dollars that would have been gifted to the government agencies through taxes and create then this advantage to use those dollars for their own charitable inclinations. And so maybe continue on a little bit more with who is the right person for this? What is the typical client that would most take advantage of this? I know we're charitable inclined to begin with, and that's the main objective. So maybe you could dive into some of the financial metrics that would be associated with that as well.
Yes, Ken. And thanks very much for bringing this up. Obviously, this strategy is not for everyone because it bears sophistication, it requiring a cash outflow. There are certain costs and expenses associated with this transaction. And at the end of the day, the economics need to make sense. So outside of charitable inclination, which is the cornerstone of the transaction to begin with, the economics would probably work for someone who, A, has an adjusted gross income of $1 million or more. They have, in one form or another, liquid net worth of $2 million or more. And I would say the total net worth of $5 million or more. Why these numbers? Because the numbers need to not only make sense from the arbitrage standpoint and confirmation that the client is eligible, enabling them to create this larger size of a check through use of financing, but it also ensures that the donors are in a strong position to utilize finance charitable giving strategy that would help them maximize their philanthropic impact while maintaining financial stability.
Absolutely. Terrific. So that paints the picture financially of what that typical ideal candidate would be here. So let's get then into maybe the top three of the benefits for these clients that meet these criteria.
I would describe them probably in three segments. You pointed out one would be gift amplification with minimal cash outlay.
Mm-hmm.
And what it is, it's effectively them being able to make meaningful charitable contributions with up to 90% financed by a specialized lender. And that particular leverage helped them to boost their giving and, of course, save on taxes. The loan is a non-recourse, no personal guarantee. It is collateralized by life insurance contract. And this innovative, in my view, approach empowers them to significantly amplify their philanthropic impact. So that's one. Mm-hmm. Number two, they have ability to create an immediate tax benefit. And I'm going to refer this back to a revenue ruling 7838. So they can unlock those tax advantages through a so-called step-up benefit by utilizing and gain up to 90% of financing, but taking a deduction up to 100% of that gift that is made. And finally, number three, I would describe it as a legacy of perpetual giving. In my example, I described that at the time of a client's passing, the loan will be repaid by use of a life insurance death benefit. And at that time, the lender would require the client to allocate up to 50% of the loan repayment amount to any charity or charities of client's choice. So this is amazing. So three benefits just to further highlight them. Number one, it's gift amplification with minimal cash outlay. Number two, immediate tax benefit. And number three, legacy of perpetual giving.
Big stuff. Alex, that's fantastic stuff and hugely impactful. It has some complexity to it. Many people are going to have a difficulty with this. Many highly educated people, wealthy people, even CPAs haven't really gotten into this much. Why do you think that is?
That's interesting, Ken, and thanks very much for a great question. I encounter this type of a question rather frequently. Mm-hmm. And in my view, the limited adoption of this advanced charitable giving strategy can be attributed to 5 key factors. Number one, there are not that many people earning $1 million or more. So mm-hmm. the pool naturally becomes relatively small. Number two, the charitable disposition, I would describe it, because even if clients do make the kind of money to qualify financially, but they may not necessarily be compelled charitably or have charitable inclinations to engage in this type of a strategy. Number three, time constraints, because these individuals often lead busy lives between the work, family, maybe some of the community works, travels, and so on and so forth. They simply may not have enough time to explore different giving and tax saving strategies. Number four, I would say habit and comfort, because we are the creatures of habit. And many are accustomed to their current financial practices in a way of, I'm okay, I'm fine, and I make a lot of money. Yes, I have to pay taxes, and it's almost like they are okay with that. And lastly, I think number five boils down to education. Like us, Ken and I think we should do a better job of educating potential donors about the benefits and possibilities of structures such this that we are talking about on this podcast. And I very much appreciate your channel because it not only broadcasts various options for the clients to explore, but it helps them to realize, wow, I guess maybe my capacity of knowledge about these various tax saving strategies are simply limited. And by listening to your podcast, I hope their horizons will be open so much and they will start think outside of the box of how they can further create tax savings.
Well, I appreciate you saying that. Absolutely. I mean, that's the whole purpose of our podcast, and that's why we entitle it Proactive Tax Strategies. And I sometimes think that kind of helps with that time constraint, that getting their attention can sometimes get them off the distractions and the busy lives that they lead and have them pay attention to the idea that there's significant tax savings here while doing good and being able to create a legacy and be able to leverage that is just an amazing thing. And so, at any rate, appreciate those words about tax savings. Everyone appreciates saving money. We clip coupons to save money. We do all kinds of things to save money. And why not get a little bit more sophisticated, or in this case, maybe a fair amount more sophisticated for the bigger numbers out there that can reduce significantly tax savings. But the real prize, as you pointed out, is to do good and to give. And that, I think, warms the hearts of everyone. And really, that's kind of where the wrap up's at this point is, what do you see with this experience of helping people with this giving? And what are the results of the strategy? What have you learned about people and the strategy over time?
Yes, Ken. And I think, needless to say, that the results of the strategy vary from client to client because every client's situation uniquely positioned differently. And however, I've observed a consistent trend, and I would describe it both in quantifiable results and qualitative feedback. One matter on this subject is once clients fully grasp the benefits of this strategy, they tend to adopt the strategy without hesitation, which is perfect. And typically, the average charitable giving is roughly $600,000 type of clients that we're dealing with $210,000 in tax savings. So psychologically, the strategy not only satisfies clients' philanthropic objectives, in my view, but also provides a sense of fulfillment and financial efficiency. Because on one end, people feel compelled on the fact that they have gifted so much. And the result of it comes with this efficiency on the financial cash outflow, which in my view, it's really a combination of both factors. And this satisfaction often leads them to not only continue with the program annually, but also to recommend it within their networks. And as a result, of course, those are who introduced to the strategy, I think, see its benefits firsthand and are likely to consider it for themselves and maybe further recommend the strategy to their further network.
Yeah, terrific. Thanks for clarifying that, Alex. It's really been a pleasure having you on the show today. I'm glad you're able to share this whole concept of charitable gift financing strategies. I don't know that very many people have heard of how to leverage this. Many financing strategies in the world of finance, and gifting is unique, I think, with this. And so, again, that unique strategy is awesome. I think you've done a great job of pointing out the value benefits and how it serves the community and people in general. So, again, thank you so much for your time here today. I think we're going to wrap things up. Any last minute pointers for you that you'd like to point out to us here?
Well, yeah, thank you, Ken, for what you do is really valuable. And your engaging questions and this insightful discussion, I think, is important for the type of a right audience that are listening. And for me, as someone deeply immersed, so to speak, in this world of charitable gift financing, it's some way easy to see its benefits, perhaps with a bit of a bias. And all I hope that today's session has sparked interest and that more people will begin to explore and learn about this strategy. Thank you, Ken.
Yeah, absolutely. And I encourage that listeners give us a call at 321-454-3623. Talk to Jenny Giroux, and we can get you more information. These podcasts will be across all of the social media platforms. And so I can go back and re-listen to that. And we also have a very helpful quiz at pinnaclequiz.com. So it's PINNACLEQUIZ.com. Go in and take a look at that. And with that, I'm going to turn it over to you, Patrice.
All right, Ken, great discussion. And for more information, how can they reach you?
Yeah, again, 454-3623. So it's 321-454-3623. Go on to our website and do the Pinnacle quiz at PINNACLEQUIZ.com. And of course, we'll also have this podcast posted on our website. And so you can give a re-listen there as well.
All right. And listeners, for more Proactive Tax Strategies podcasts, simply follow this podcast and, of course, share with others. Thanks so much for being with us.
Thank you for listening to the Proactive Tax Strategies podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.pinnaclefinancialwealthmanagement.com or give us a call at 321-454-3623. Securities offered through Arete Wealth Management, LLC, members FINRA and SIPC. Investment advisory services offered through Arete Wealth Advisors, LLC, an SEC registered investment advisory firm. Pinnacle Financial Wealth Management, Arete Wealth Advisors, and Arete Wealth Management are independent entities.